The U.S. economy just pulled off a surprising rebound, but not everyone is convinced it's here to stay. Real gross domestic product, GDP, surged by 3.8% in the second quarter of 2025, according to the latest data from the U.S. Bureau of Economic Analysis. But here's where it gets controversial. This growth wasn't driven by what you might expect. Instead, it was fueled largely by a drop in imports, which actually subtract from GDP calculations, and a spike in consumer spending. But is this growth sustainable? Let's dive in. The second quarter's performance marks a sharp turnaround from the first quarter, when GDP shrank by 0.6%. The key drivers? A significant decline in imports and a robust increase in consumer spending, though these gains were partially offset by decreases in investment and exports. Interestingly, the initial estimate for GDP growth was revised upward by 0.5 percentage points, largely due to stronger than expected consumer spending. And this is the part most people miss. Even with this revision, there are still questions about the underlying strength of the economy. Breaking it down further, real final sales to private domestic purchasers, a measure of consumer and private investment spending, rose by 2.9%, up from the previous estimate of 1.9%. From an industry perspective, private goods-producing industries saw a 10.2% increase in real value added, while private services-producing industries grew by 3.5%. However, government spending took a hit, declining by 3.2%. This raises a thought-provoking question. Are we relying too heavily on consumer spending to drive growth? And what happens if that slows down? On the inflation front, the price index for gross domestic purchases rose by 2.0%, slightly higher than earlier estimates. The Personal Consumption Expenditures, PCE price index, a key measure of inflation, increased by 2.1%, with core PCE, excluding volatile food and energy prices, rising by 2.6%. These numbers suggest inflation remains a concern, though not as acute as in previous quarters. Corporate profits, however, painted a less rosy picture. Profits from current production increased by just $6.8 billion, a significant downward revision from earlier estimates. This could signal challenges for businesses, particularly in a high-interest rate environment. Could this be a warning sign for future economic growth? The annual update of the National Economic Accounts, covering 2020 through the first quarter of 2025, provided additional context. Real GDP grew at an average annual rate of 2.4% from 2019 to 2024, unchanged from previous estimates. However, the average of real GDP and real gross domestic income, GDI, was revised upward by 0.1 percentage point to 2.4%. During the economic contraction from late 2019 to mid-2020, GDP plummeted by 17.4% annually, though the subsequent recovery saw GDP grow by 4.5% through early 2025. For the first quarter of 2025, GDP was revised downward to a 0.6% decline, reflecting weaker investment, government spending, and exports. Consumer spending, however, was revised upward, offering a glimmer of hope. Is this a sign of resilience or just a temporary blip? Looking ahead, the next GDP release is scheduled for October 30th, 2025, and will provide the advance estimate for the third quarter. But before we go, let's leave you with this. As consumer spending continues to prop up the economy, how vulnerable are we to a slowdown in this key area? Share your thoughts in the comments. We'd love to hear your take on whether this growth is built to last or if we're on shaky ground.